Well, g'day there traders and friends, market participants and enthusiasts right around the world. You are here with James on behalf of Pivot Point Trading as I sit down and bring you a Thursday morning pre-market address as we transition into the trading session beginning, of course, the 16th of March. This is going to be a continuation off from the very last market update which I left you with, and of course what we'll be addressing or looking for moving forward. But before we get into that component or that aspect of the analysis, I first want to refresh what we touched on in the analysis video a couple of weeks ago. Really, it was this particular candlestick pattern combined with this gap to the upside, and I'll write it on the screen for you right now, even though my writing using my pen drawing tool isn't all that nice. It was that ADX indication. We were looking for that to actually turn down and warn us that we were going to move into this sort of prolonged sort of sideways move, potentially a little bit of a pullback in conjunction with this very strong bullish move, which we have seen play out for a number of months now. Well, fast forward, and since that address, of course, being over the last 2.5 weeks, we have more or less moved sideways. It really wasn't until yesterday on the back of the Fed's decision to raise interest rates where we saw the market itself spike a little bit with some pretty decent volume, up 112 points on the Dow Jones Industrial Average, and it's looking as though we're going to see a little bit of follow through into Thursday's trading session. Now, let me just bring up the ADX for you, because what I was talking about last week was to pay attention when that ADX signal turns down. And as you can see, we were getting prints up here just below 75 on the ADX. It has had about 2.5 weeks to somewhat reset. We're still not as low as what we'd like to see for the next upward leg, if in fact we're going to see again a continuation to the upside, but it has been a rather non-eventful past couple of weeks worth of trading and rather dull in terms of the overall markets breaking to new highs. We'll see, of course, what happens over the next couple of weeks, but really before we get there, I just want to sort of lay the groundwork or the framework of what you should be looking for as we move and really progress throughout March and transition into April 2017. So as you can see, again, we're moving into Thursday's trading session. What you should be paying attention to, of course, is this swing point right here. What we've done since this gap and since this sort of tweezer top reversal type of pattern is that we've sort of come back down, or we have come back down. We filled this gap. We've stabilized at the gap. I mean, we haven't pushed below it. We haven't sort of broken that gap support at the current juncture, and we're still holding above these exponential moving averages, which is rather healthy, of course, for the markets moving forward. It's the same for the S&P 500. You can see the S&P 500 pulling back down into these rising exponential moving averages. Again, we filled the gap, and it is holding as gap support, and it looks as though once again that we're starting to see the push or potentially that next leg to the upside. The Nasdaq, it didn't really pull back as deeply as what the Dow Jones Industrial Average did and the S&P 500, and we are more or less back up at these respective highs. Now that I look at the Nasdaq, I just want to show you two particular stocks which are again at relative or very close to all-time highs. We have Google, which is sitting on the potential on the precipice of a breakout. You can see right here, if we go to the weekly chart and zoom out, we've been trying to overcome this resistance level here, just around $860 a share. We're closing at $868 as we move into Thursday's session. And it looks as though if we do get this push above $874.90, well, then we'll have a very quick dash, a very quick run to about $910 at a minimum. And the secondary stock that I want to sort of alert you to at this particular time, again, before I move into some of the market structure, is that Amazon. It's been one of those few reluctant tech companies, along with Google, to actually break out of those recent highs. You can see that if I bring up these Bollinger Bands, we're really starting to get that squeeze as well. And it's looking as though something big is about to happen. If I take this one step further again, you can see the ADX has reset. The commodity channel index as well is holding above 100. So this is very favorable, and the odds of a breakout for Amazon and even Google as well are quite high at this particular time. So they are potentially two stocks to keep on your radar. But going back to the discussion in the overall market setup, the framework, and I guess the structure more importantly of this market, is that there's a lot of people at this particular point, again, jumping in and buying this dip. And there is one sort of reason or one cautionary tale which I want to bring to your attention, and that is that we're still essentially in the pullback type of phase. What happens is when we get these sort of very extreme extensions in sentiment and also the overbought nature of a market, we have to go through some form of a resting period. And I'm assuming personally that this market, or at least the resting period that we've had over the past 2 weeks, it really isn't suffice enough for the next leg up. And the reason I'm saying that again is because these oscillators are still in reset mode. More importantly, or most importantly, is the MACD. The MACD is only recently crossed, and it's sort of in this correctional sort of bearish outline at the moment. And again, it's very rare to see this cross bearish and to only hold for 2 weeks and to see it turn back up and to see the trend continue. The stochastics is still resetting its move from at least that overbought setting. It has sort of recalibrated back into a normal or more so a neutral sort of reading. The RSI is jumping back and forth. It's a lot more delicate in its response or reaction to price sensitive information. But again, continuing on, what is also very important is the ADX. It is still turned down. It hasn't actually turned up on this most recent bounce, which of course we discovered, or at least the market priced in on Wednesday. And again, that is across the board. If you pay attention to the S&P 500, pay attention to this ADX, it hasn't reset. It's still holding and printing above 30. And on the NASDAQ, it is very close, and it is probably the most eager of the three markets moving forward. What I can see happening, and again, this is just sharing my, I guess, a little bit of wisdom that I've sort of developed over the years of being a professional trader, is that when we see these types of signals, again, a lot of people are willing to jump in at the buy the dip. However, in this sort of context, often what happens is that you have to pay attention to the actual pivot point, and the pivot point is very, very important. What we've established right now, if I just draw it on my screen, is that we have this swing high coming in on the Dow Jones Industrial Average around 21,120, give or take a couple of points. You can see that we've got the close on this particular day's worth of trade. That was the 1st of March, and then on the 2nd of March, we opened more or less at that exact same spot, and it was what set up that sort of tweezer top reversal pattern. Generally, when you get the pull down and you pull back down into the exponential moving averages, and people obviously identify that we're trading back into the 10 and the 20, and they identify it again as a buy the dip opportunity and a potential to reset positions, or at least to enter into some very short-term trades. Often what happens is that you'll bounce, you'll come back up and you'll retest this pivot point, and it isn't assured, or it isn't a sure thing. Obviously nothing in the market is assured or is really of certainty at any time. But often what happens is that we'll actually slow down at that very same pivot, and there's a very high probability and expectation that if this consolidation, or at least this short-term slowdown in price action and market action over the past 2 or 3 weeks isn't enough, we will come back down and probably revisit once again around 20,775. So if you're entering in, or at least thinking about entering into market positions, I would encourage you to rethink that, because the probability of this failing to break out above this level over the next 1 week is actually quite high at this particular time. So what I would be encouraging you to do is to watch this pivot point here around 21,112. It is very, very important. What you can do is you can sort of think about the possibility of entering into positions once we see the break of the swing high, once we get a confirmed close above, and then of course a continuation following through in a consecutive trading session to the upside. That would very much so increase the odds of a profitable trade, and more importantly, of course, a reliable move to the upside with grit, which is going to continue for more so an indefinite period of time. At this particular point right now, there's more questions than answers, and it is a little bit, in many ways, a little bit too eager to be jumping into these positions, given, of course, this very strong reversal, at least this candlestick pattern which we've seen here, aligned with this chart pattern being a gap, which at this particular moment, we're a little bit unsure if it is some form of a measuring gap, what we call the continuation gap, or if in fact it is going to sort of turn out to be some form of an exhaustion move on the intermediate time frame. Now I want to keep, or at least update you on a couple of additional points as well. Now I'm not going to be addressing really any of the individual stocks at this particular point. If you'd like to learn about individual trade analysis, I would encourage you to have a look at this weekend's pro analysis class. It is a recording and it is held on the website. But again, just to sort of surmise this quite simply, what we're seeing right now is the Bollinger Bands again beginning to squeeze. If anything, we're starting to pull away from this top band. That sort of correlates really well on different fractals, whether it is the daily time frame, whether it's the weekly time frame, and also the monthly time frame. Things are looking a little bit tepid at this particular point, and often what we see develop around these types of extremes, again, this is just on the intermediate time frame. I'm not talking about some form of a sort of a macro top at this particular point whatsoever. Again, it's just a little bit of a slowdown in this trend, and you don't really want to be positioning yourself into a slowdown. You'd rather be waiting for that next leg to the upside and capitalizing on it immediately. But again, if we push on up back up into this pivot point, up into this resistance area, and we start to fail, or at least if we get a reversal, well, then that really shows the neckline of potentially a short-term double top. If we hold around these levels, and again, this is what I'm thinking is going to happen, is if we just sort of just stagnate around these levels, or even if we come back up here and sort of linger, you should be paying attention to the Bollinger Band squeeze, which may also set up as well, because if that does, the odds of a continuation go up exponentially. As long as we don't break that 50 exponential moving average, you have to look at this market constructively, but at the same time, you need to really cherry pick your entries and understand the right time to be going long in this market, because really the probability that we do slow down at this pivot point, we may rocket there on Thursday. We may be here at the close on Thursday above 21,100, which wouldn't surprise me whatsoever. But that might be sort of that last final push on up before we get that true sort of resistance area, which is sort of bound to hold. Now, obviously, we've been very constructive in our outlook. We've done very, very well with a lot of individual trades and also overall market exposure. But again, when you start to see these potential double bands develop, you can see the neckline, which I've just drawn on my screen, and also potential resistance areas. This is coming in just shy of 2,400 on the S&P 500. And of course, at anything really, or if anything, the development of what we call a Bollinger Band squeeze, you know that volatility or even the likelihood of immediate follow through is actually quite low at this particular point. Again, the Nasdaq, the most developed of the three, or what I could say would be the most eager of the three, given that we are more or less back up at that same point. It's going to be very interesting to see what the Nasdaq does, because of the three markets, it looks as though this may be the first market to push. And then again, of course, according to Dow theory, we need to see the other two markets confirmed to the upside. So I hope and I trust that that has helped you a little bit in understanding sort of market sentiment and how to sort of approach this market moving forward. You can see in the past all of these sort of entries we've had moving forward. And again, this has been the slowdown based off that very important candlestick pattern and that gap, which I referenced in the last video, aligned with the ADX. And again, the ADX hadn't turned down at that particular point. It really wasn't until, again, 2 weeks, or at least 2 to 3, maybe if not 4 days after that recording, where we saw the definitive turn down in the ADX, and the rest is history. You can see the market slowing down. So again, I'm just warning you to potentially rethink some very aggressive bullish entries at this particular point, because there's no guarantees, again, that we are going to get above and hold above and continue above these respective resistance areas on the Dow Jones Industrial Average and the S&P 500, when we still, or at least it looks like according to the technical indicators, that we still need to see a little bit of a consolidation, or at least a longer sort of holding pattern until we can really sustain continued higher prices moving forward. The final thing which I want to keep you with, and again, this isn't this is just because it is constructive on more so the bigger fractal, again, looking out and sort of looking at the macro picture of this across the board. I mean, if you put this in context of where we've come from, where we're going, where we've been, where we currently are, you can see this has been a very, very aggressive sort of top, or at least a very aggressive trend continuation. And at the moment, it seems as though the market can't do anything wrong. It sort of just dispels any sort of weak or negative fundamental data. And it's as if really there's only one direction to this market. Again, it sort of mimics or echoes a very strong sentiment, if not some form of an extreme sentiment to the greed side, or at least the mania at this particular time. But when we start sort of deconstructing the actual price action and sort of quantifying it through indicators, you can see for the MACD, especially on the monthly time frame, that we're just developing some very extreme divergence on the monthly charts. And again, this is holding. This is the Dow Jones Industrial Average. This is the S&P 500. Let me take the annotations off the screen so you can see this. You can see again that we're still putting in these lower peaks on the MACD relative to these higher highs that we're establishing on the monthly time frame in price. Even though the candlesticks still look very good, this divergence is somewhat concerning. Now, it isn't something that we immediately act on, but it's very important that you reference it and pay attention to it from time to time. If you go back in the past and you get to recent tops as well, when you see the cross on the MACD, or at least the momentum shift on the largest fractal that we sort of look at as technical traders, it is a rather sort of ominous signal moving forward. And if you put this again into context of where we've been since early 2009 to where we currently are, relative sort of period on the yearly time frame, early 2017, you can just see how overextended this market is, and how we're really trying to sort of push momentum to the absolute extreme to sort of hold these relative highs where we're currently trading at. So that's very important for you to understand and to look at from time to time as well. But it isn't something that we trade off from immediately. We need to look for certain signals of confirmation and to see some trend lines and certain things like that actually start to break down before we can really start addressing that in any more detail at this particular time. So on that note, everybody, I hope you're having a enjoyable and fantastic week. We are halfway through the week. We've got 2 more trading sessions, Thursday and Friday. There is a lot of trading potential and opportunity to really round out this week, but at the same time, if you're looking at getting into market exposure or trades directly applicable to, say for instance, the SPYs, the diamonds, or the Qs, I would encourage you to rethink that and think about these pivot points which need to be overcome to see the markets in agreement, and just the expectation of what consolidation truly is and what to at least expect when we're potentially moving into some form of a slowdown, or at least a sort of recalibration of an overbought, overextended extreme, which happens from time to time on financial markets, because really we have all of the signals for that. But at the same time, we're not calling for any major pullback. It is more so just a slowdown in price. And obviously that's going to flow through to a lot of individual companies as well. So that is essentially Thursday's morning pre-market update. It's James signing off on behalf of Pivot Point Trading. I would encourage you to have a look at Pro if you are interested in learning how to break down financial markets and individual trades as well. All the best, everyone. Enjoy your day. Goodbye.